for the last two panels. One of them is going to be moderated by me, so I would like to welcome you on the stage and I'll introduce your names. Please have any seat you would like to have. So, okay, good to see you from this view. So our panel is about lending, crowdfunding, and peer-to-peer lending, and we're with Prescott Watson. Prescott, you're welcome. So he's the Director of Special Projects at OutCrowd, and he's a founding employee and is currently Director of Special Projects and the world's leading equity crowdfunding platform and Israel's most active venture investor. And John Goodall, CEO and co-founder at LendBay, and LendBay, which is launched in May 2014, is the only peer-to-peer investment platform to focus solely on the UK residential mortgage market. Yeah. So it's going to be fun. So I've been in fund management business and financial markets for about 10 years. So for God's sake, can you please tell me what is crowdfunding?
So I think there's two big ideas behind crowdfunding. And the first idea behind crowdfunding is that you are securitizing things and offering those securities online to direct to the consumer and cutting out the intermediary. And the other idea behind crowdfunding is what has come about from this Kickstarter phenomenon, which is where a consumer has a direct relationship with something that they're backing in a financial way. And if you look at both of those and kind of put them together, you can start to see what OurCrowd has built. We are a crowdfunding platform. We actually prefer to call ourselves an online venture capital firm. The idea is that we have an investment team that looks a lot like the investment committee at any VC, but instead of raising a large fund and then deciding to invest in a bunch of companies, instead we decide to invest in a company and then let anyone who is a certain net worth around the world invest in those companies directly on our online platform. So basically we're allowing high net worth individuals to get access to angel capital type investments that have been negotiated and diligenced by a professional team. That's what we define crowdfunding as.
I see. So you're acting like fund of funds and people giving you their money because you're finding many good companies or good loans to give people away. Is that right?
So we are definitely not a fund of funds. Instead, the way to think about this is that typically a venture capital fund will raise one fund of $100 million, and that one fund will invest in 20 or 30 different startups. Instead, and the LPs in that fund are in that fund and are therefore in the 20 startups. They didn't get to choose themselves. So instead, the OurCrowd model is taking a process of finding companies, and we're doing that exact same process. We're applying the same level of diligence that you would have at any VC. But instead of raising one large fund, what we're doing is we're raising individual funds for each company. And that means that people who go to our website that are accredited investors can choose to invest in individual companies through each of those individual limited partnerships. So we're bringing, you could say, the professionalism of VC, but we're giving the access of crowdfunding, and that's sort of the secret sauce.
Okay, so I think it's a bit clear in my mind now what is crowdfunding and what is not. But peer-to-peer lending is a bit different. So we're going to be talking about the differences, but basically, what is the concept of peer-to-peer lending, especially in your business?
Well, the concept of peer-to-peer lending, I mean, the parallel of crowdfunding is very similar in terms of disintermediation. And so if you think about what banks do, banks take deposits in, and those deposits, as far as the depositor or consumers involved, they are totally risk-free. And what the bank then has to do is to lend those out. So the bank is kind of guaranteeing no risk on one side. On the other side, it is making some form of lending decision which has some inherent risk. Depending on the type of lending it's doing, it may be a tiny amount of risk, or in unsecured lending, it might be slightly more risk. And so what we're saying, and basic consumers, certainly in the UK and the US, pay quite a lot for that sort of risk transformation to guarantee their money. And obviously, in certain times in the economic cycle, it becomes very worthwhile and very useful, as it did in 2008, as banks received bailouts. But actually, in certain types of assets, and in most cases, a consumer, you don't really know what your bank is lending against. You don't know whether, and I won't mention one, a certain high street bank in the UK is very focused on mortgages or focused on consumer debt or SME. And so what peer-to-peer lending is doing is saying, actually, get a higher return, but you take on some risk. So rather than that transformation, the platform itself will do the underwriting, origination, and servicing, and it will say exactly what it's doing. And you can turn around for a small amount of risk, say, we want to invest in mortgages with us, or consumer loans, if it's someone like Zopa, or business lending with something like Funding Circle. So the model is similar, but rather than being an equity investment, you are basically lending to someone. And the other thing that peer-to-peer lending does as crowdfunding is, our average mortgage is £200,000. We break that up into 200,000 different mini contracts. Now the borrower only has to sign one contract, but it means that people can actually therefore diversify and put a pound into multiple numbers of mortgages, if that makes sense. So it allows this sort of relatively large investments to be split up into sort of tiny parts.
I see. Okay, so in Landbay, are you basically doing this? Do you have any business, any other businesses, or you're just doing peer-to-peer lending? This is what you do.
It's all we do, peer-to-peer lending. And again, we're earning mortgages, and we started off focusing on one particular part of the UK mortgage market, which is the sort of buy-to-let market or the rental market. That's about a 20% of the UK mortgage market. And the reason we did that is because the regulatory regime is different and the relative safety and pricing is more advantageous as well.
Okay, great. Prescott, so coming back to you. So what are you exactly doing? So you mentioned about companies. How many companies did you invest so far? As far as I can know, it's more than 90, is that right?
Yeah, so we're about almost 4 years old. And so far we've invested in about 95 companies, mostly in Israel, but actually increasingly we're investing in US companies, invested in a UK company, an Indian company. And our average check size ranges between $2 million and $5 million. So altogether we've deployed about $220, $230 million into these companies. One thing I wanted to point out also to try helping to differentiate between the peer-to-peer lending space or the marketplace lending space and the equity crowdfunding space is that, obviously you'll be able to talk about your monetization regime in more detail than I can, but fundamentally it revolves around the difference between we seek to monetize on the upside. So we are a fund that will take carried interest on the success or the profits from the company's successes. Whereas if you're looking at peer-to-peer lending or marketplace lending, it depends on the type of model you're using, but those are companies that are primarily focused on transaction fees or brokerage fees or something of the sort. And that's another big area that we diverge in.
I see. So
yeah, on that point, I agree that there is that difference there. And I think the US models work very much like that. And that was one of the criticisms of sort of what happened in Lending Club is that actually revenue stream is very much sort of one-off when they lend. So they stop lending. I think the UK models are slightly different where they probably charge less upfront and more over the course of the loan, and they don't take that margin if the loan stops performing. So while at the same time they don't have skin in the game, the revenue is based not exclusively on servicing, but a sort of more even split between both lending and the sort of servicing margin, if that makes sense.
Okay, so we saw the differences. One thing in my mind is that your company is aged only 3 or 4 years, but you invested in many, many companies, so it seems to be a bit, very fast. So can you please tell me, where do you think this is going in the near future or for the
Sure. It's been a really incredible journey at our crowd to look at the way that wealthy individuals around the world have really wanted to get into the VC asset class. And meanwhile, there's probably been no better time than today to be investing in the VC asset class. And yes, obviously there's cycles, there's ups and downs, there's bubbles, but there are so many opportunities for technologies to change the way that things work that the opportunities for finding high return exits are enormous. And so this is driving an enormous amount of interest into this asset class, and that's really what I think has been underpinning our growth. In terms of where this is going, it's hard to see into the future, but I think that our crowd and other crowdfunding platforms that have a similar model to ourselves are positioned to become a destination for high net worth individuals around the world to access many different types of private placements, right? So we're focused right now on tech startup equities, but in the long term, and I mean truly in the long term, I believe that the real upside potential is for this to turn into a platform where individuals can access all sorts of private placements, whether it's structured debt or project financing or real estate, and the list really goes on and on. So that's where I think that this sector is really heading.
So what are the barriers and obstacles you see for yourself? For example, we're talking about Federal Reserve raising rates, the mortgage crisis in the US, 6 years before. So what are the dangers for your industry?
So it's hard for me to talk about such a wide variety of risk factors to the macroeconomic environment. And fortunately, when you're in this industry, unlike I think a lot of other peer-to-peer lending industries, tech investments, especially in early stage companies, this is not something that's going to be responding to interest rate hikes immediately. These are very long-term investments that are more calculated bets on the ability for a technology to be adopted, calculated bets on the way that industries will change. It's not the kind of thing that you can compare to technical analysis on a stock. And I think because of that, you're going to see that the ability for companies like our crowd that are focused on tech startups to continually drive investor interest is going to be quite strong.
I see. So the same question, I think, which is true for you as well. So do you have so specific targets, like you invested in 95 companies in 3 years or 4 years? Are you growing that much fast?
Yeah, so I mean, again, we're lending in mortgages, and the UK mortgage market is huge, and we're an absolute tiny part of it, and we've been lending for about 2 years. And to put it in perspective, we lent 20 million last year, and we lent that this quarter, the first quarter of this year, we sort of doubled the amount of lending. Now, there's slight seasonalities to the UK mortgage market, and we wouldn't expect that sort of growth to carry on in the short term. But we're looking at lending sort of 300 million next year, and then sort of $500 million the year after. And we have a great advantage in the UK where peer-to-peer lending is about to become, for individuals who lend up to £15,000 per year, totally tax-free in terms of their returns. And that £15,000 they can layer up year on year. And so, the cost of our funding is increasingly, from a retail perspective, is increasingly going to fall. In terms of the market we operate, in terms of buy-to-let mortgages, the capital requirements that are being imposed by the latest Basel consultation, as well as interventions by the PRA, which is the regulatory side of the Bank of England, mean that the banks are going to increasingly be restrained and have higher capital requirements on what they do, which is going to push up costs. And in our space, we expect it, for an average mortgage, those capital requirements to increase by a factor of 150%. So it's quite material. So, we see this sort of scenario where we are sitting today is where we're not affected by those capital requirements. And from a retail point of view, and we can come on to institutional later, that our cost of funding over the next sort of year or two, we'd expect to fall significantly, whereas all our competitors would expect it to see it grow. So, our head of lending, who came from Paragon, which is one of the big non-bank lenders, he jokes to us, says, unless you were lending $1 billion a year in the UK mortgage market, you're a small player. And so in terms of our aim is obviously we don't want to be a small player. And so that's our target, whether it's going to be 2018 or 2019, I don't know. But, we're in a large market and we have some, genuine advantages over banks in some cases.
I see. And I think the last question is one question that is going to come to the mind of a regulator. So regulation is important. Who is regulating you?
So peer-to-peer in the UK is regulated by the FCA. And I think it's the first market where it has been regulated across Western Europe or America. What that means is that actually in the UK, it's not just sophisticated investors that can take part. So in many countries, both in I know US and in Australia and certain parts of Europe, you have to either have a minimum investment of $50,000 or 50,000 euros, or you need to tick the fact that you're a sophisticated investor. In the UK, anyone can do it. So our minimum investment is £100. Some platforms have it for 500, some less than that. And we are regulated by the FCA, and that's what's allowed us to get into this kind of tax-free, what's called the ISA regime. And most of that, the regulation in the UK is very much focused on protecting the consumer investor. And so it's around about handling client money. It's about how you market your promotions and highlight risk. And having some sort of backup solution so that if one of the platforms were to go bankrupt, the people that invested still can, get repaid their interest and capital. So that's the three main tenets of the regulation. I mean, there's a bit more than that, but it's mainly around the investor as opposed to the borrower, if that makes sense.
I see. What is your track record, by the way? Bad debts, NPL?
So we've now lent on over 200 mortgages. We haven't had one late payment. Oh, and now again, part of that is, we have a very, as our head of lending came from one of the best lenders in the country, and we spent a lot of time focusing on our sort of credit criteria. However, it's worth me saying that the UK, actually all forms of lending in the UK, particularly buy-to-let mortgages, we're in a very benign credit environment. So, we're not saying that we expect that to continue forever. We're going to expect late payments. It is secured. We're going to expect some defaults at some time. Of course we are. So, but, in the UK right now, even lenders who have got books of multi-billions often have a single number of accounts in arrears at the moment. So it's a very, very benign environment.
Credit is cheap, yeah, you're right. Yeah. So, Prosecute, who is regulating you, by the way?
So it's really important to note when you look at our crowd that though we call ourselves a crowdfunding platform, we are not playing in any of the types of private placements that are invoking new forms of regulation, meaning our crowd is essentially regulated as a venture capital fund or a private equity fund would be. So we operate under the US SEC's VC exemption, and we are only a platform available to accredited investors or high net worth investors. And it's not because we don't want this asset class to be accessible to a wider array of people. It's because we could get into the philosophies of why those regulations are in place and why those thresholds are in place, but we would rather operate in a very clear regulatory environment. And furthermore, we believe that when you're attracting an investor base that can deploy hundreds of thousands of dollars per individual investor, it's just an easier situation for us to handle, and also it allows us to scale more rapidly in our early years.
I see. So for a long time, I invested in companies. I looked at research reports, sometimes technical analysis, but not to a certain extent. So I searched many. So if someone is going to invest in money, do they have sufficient tools? So what are they doing?
Yeah. So we on our website we explain quite a lot about the type of lending we do. We make all the lending decisions. So there are two models within the UK, and probably this is true for peer-to-peer around the world, where you either go on and you pick your loans individually and you do it one by one, or you go on and you sort of look at the credit, the general sort of asset class, and you put your money in, and the platform diversifies it for you. And we fall into that second category. With sort of relatively mainstream, low-yielding mortgages relative to SME, we felt that model works better because the differences between different mortgages, trying to guess which one is going to default or has the highest chance of defaulting, is not necessarily linked to loan-to-value, which is where people think it is. It generally, in the space that we're in, the most default comes around something that happens to that individual's life, which generally is around divorce, alcohol or gambling, or drugs, which is very, very hard to predict at the time of underwriting. We haven't started using Facebook as a method of credit scoring, but there could be an argument to look at it on that basis. And so we do all that. So the house gets valued. We send a valuer to the house. We verify all the documents. We do all the AML checks. We go through. We have our own credit model. And the key thing within mortgages is to diversify. We do also provision. So that we will take some element of first loss as well on mortgages.
Okay, so if I one day make a judgment and decide to put my money on your company, so what should I be looking at? If I'm going to buy a chunk of your company, so what should I be looking at? What am I going to assess?
Sure. When we launch an investment opportunity on the OurCred platform, we basically provide investors a wide array of materials to help them understand both our investment thesis as well as the risk factors behind that particular investment. And unlike being able to diversify across buying chunks of mortgages, equities in early stage technology companies are impacted by a wide array of market factors that are really difficult to predict, right? So it's not the kind of thing that you can underwrite to provide a risk assessment in a reasonable way. What we aim to do is give as much transparency as we can into the history of the business, into the people behind the business. I mean, in almost every case when we make an investment, we know the team quite well. In fact, one of the things we do, and you mentioned tools a minute ago, I don't think that tools are just the things that are online for people to control their portfolios. Tools are the investment the investment criteria that we go in with to ensure that we have visibility into the company's P&L, we have visibility into the company's decision making, we can have veto rights over certain types of actions. So they're not always online tools that people use to manage their portfolio. It's actually the actual inner workings of how ongoing company management works. In terms of what you should be looking for, we look at 6 things. First thing is, as I mentioned, team. Second thing is, these are early stage companies and they have to be looking at very large markets. Third thing is the technology. Is there a technological differentiator? The fourth thing is the ability to scale. So do they have a business model that can really take them quite far? The fifth thing is a number of risk factors, from market timing to, the list really goes on. And the last thing is this a good deal, right? So we don't want to get into a company that is in early stages and yet has a valuation that's appropriate for a Series C financing, right? We want to make sure that the exit will actually return to the investors. So those are the 6 criteria we look at, and we try to explain all of those things to the investors with each opportunity.
I see. Okay, that gave me a clue. So let's continue. I'd like to ask you about little loans. When it comes to loans business, we need usually secondary markets. Do you also need some secondary markets to maybe, the coins to liquidity?
Yeah, so we have secondary markets, and under this new ISA regime, anyone that's offering an ISA, which is this tax-free wrapper in the UK, has to have some ability to have some secondary markets. Ours are used quite actively. We don't at the moment charge a fee for it, and so people who want their money out to date get it back in an average within 24 hours. So liquidity is quite high, but at some point we can't guarantee that liquidity, of course. So we do market it as a long-term investment, but as I say, because mortgages are by their nature slightly longer term. Ours are not 25 years; they're typically sort of 5 years or so. But liquidity to date has been very, very strong, and we've purposely linked ours to LIBOR because if there is a liquidity crunch in the banking system, we're likely to have a liquidity crunch too, and so therefore we felt it's appropriate that if there is a liquidity crunch, LIBOR should reflect that better than the Bank of England base rate, and so therefore if there is a liquidity issue, then at least investors will get compensated for it to some degree.
John, what do you think your company is going, or this business is going? Do you think it's going to grow up much, much bigger, or are you expecting to be, purchased by a bank someday?
I don't see us being purchased by a bank. I think we'll grow significantly over the next 3 to 4 years, and I think we've now spent a lot of time building the team and the technology, and now the environment is right. I think it's more likely we'll work with banks, and the thing about whether you call them marketplaces or peer-to-peer, increasingly the way the mortgage market and our part of the mortgage market is going is that banks, I do think, as Alistair was saying earlier, will start to collaborate with platforms, and rather than setting up niche lenders, they'll use platforms to invest through. And we've had discussions with some of them, and we still are, and because they're banks, those discussions will take a number of years, and they're unlikely to sort of move that quickly. And so the danger for us as a platform, if you're bought by a bank, you're pretty much closing off most other institutional suppliers of capital. And I think our business is far more valuable if, and actually more stable, if we have a diverse source of capital that may include, retail and big institutional, which might include banks, may include funds, it may include large family offices, etc. So the danger, I think, of it being incorporated into a bank is it just becomes an origination platform for the bank, which I don't necessarily think. I think it wastes a lot of the value that we've created.
Okay, let's talk a bit about regionals and Turkey, maybe. We can see that companies mostly coming from the US, the Europe, and Turkey is a newcomer to the market. So what do you think about emerging markets, the potential in the emerging markets? What do you see?
So without mentioning Turkey at first, it's been really interesting to see how within markets that were somewhat closed off from the rest of the world, at least in the sense that it was difficult for Western entrepreneurs to reach them, you've seen gigantic companies form that, and I'm talking about China in particular, that a lot of times are ridiculed at first for being copycat companies. But the more you start to look at what they're doing, you actually see a lot of very unique innovation around adapting products to cultural norms, around adapting supply chains to make the products affordable to the price point that developing market consumers can pay. And I think that the opportunity for us to translate a lot of what might be seen as luxury services in the United States into very transformative services that impact the rest of the world at a totally different price point just several years after those services introduction, that's huge. I mean, imagine Uber, for example, right? It started out as a way for relatively affluent people to get a black cab or a luxury vehicle to pick them up and drive them around. Pretty soon, Uber's going to be powering tens, hundreds of thousands of jobs in the developing world like India and China in terms of drivers and whatnot. I mean, these are really interesting opportunities to see something go from the developed world to the developing world. Looking at Turkey in particular, this is my fourth visit, I think, in the past few years. And one of the things I remarked earlier today was every time I come here, it's incredible to see the real estate development that's going on. So there's very rapid development. And likewise, you're starting to see the basis of a good startup ecosystem starting to come about. Part of that's the right government incentive programs. Part of that is I think that there's so many universities and the education system here is very good in Turkey. But it's going to take a while for Turkey to start to rival the robustness of the startup ecosystem you see in countries like Israel. It takes time.
Okay, John, so you coming to Turkey, I think you saw all those construction activity, people, people are young, people need financing. Maybe one day in Turkey, is it possible?
Yeah, I mean, it's my first visit to Turkey, and so I wouldn't expect to, know a huge amount about the Turkish mortgage market. In terms of emerging markets more generally, I mean, what I'd say is, if you look at China, China is now the biggest peer-to-peer, has the biggest peer-to-peer sector of any country, and there are businesses there that 2.5 years ago didn't exist that are already lending more than Lending Club was last quarter, and people like Funding Circle and Zopa. So, they are genuinely peer-to-peer in the sense that people they have pretty much just app-based, and people are depositing, $100 a time, and they're using it like a bank, and they're absolutely huge. And I've seen that sort of going through other parts of Asia as well, and obviously up until the last few years, it's very much been the UK and the US which have been the large peer-to-peer markets. I mean, what I would say about peer-to-peer lending is that if you look at the inflection point within the UK, it was actually the financial crisis. And actually the banks doing something not very well or badly or missing a trick or having their brands tarnished definitely helped the sector. And I think there's no doubt about that. And the same is true sort of in the US, that the banks have effectively created an opportunity for these companies to exist. And in fact, I was at a conference in Australia earlier in the year, and again, the Australian banks, I think probably like the Turkish banks, they're very well thought of, and they had a very good crisis. They're kind of people like their bank, and peer-to-peer has found it really hard to sort of get a foothold there. And so I think that maybe, from what I understand from today, is that the Turkish banks probably are doing better than the British banks, and so maybe that opportunity set isn't there in the same way as it is in Western Europe or in China, where there's a lot of unbanked, or in the States.
I see. Okay, thank you for your remarks. I think people just got into the idea what is crowdfunding and what is peer-to-peer lending. If you have any questions, I'm sure we have no time left, so we will have a short film and we'll go to the last panel. Thank you. Also, thank you.